DFIs and their roles in countries' economy. Most countries in the world, whether advanced or developing, have development finance institutions, and where they do not, multilateral institutions step in. The United States has the Development Finance Corporation, the United Kingdom has British International Investment, Germany has KfW and DEG, France has Proparco, Japan has JBIC and JICA, China has the China Development Bank and the Exim Bank, India has NABARD and SIDBI, Brazil has BNDES, and South Africa has the Development Bank of Southern Africa. Pakistan too has had its own institutions such as the House Building Finance Corporation and other joint venture DFIs. On a broader level, regional and multilateral bodies such as the World Bank, the Asian Development Bank, the Islamic Development Bank, and the African Development Bank extend similar functions across various countries. The rules that govern such institutions are generally distinct from those of commercial banks. They are not designed to maximize profits but to fulfill a development mandate. Their establishment is usually through law or government charter, and their governance follows strict oversight by governments or international boards. They are expected to maintain financial discipline, to follow prudential norms, and to uphold international standards in environmental and social safeguards. In many cases, they must work in partnership with the private sector, co-financing projects in a way that leverages their resources and reduces risk for private investors. The functions of development finance institutions are equally well defined. They provide long-term finance in areas where commercial banks hesitate, such as infrastructure, housing, energy, or agriculture. They fill financing gaps in regions or sectors that remain underserved. They nurture private enterprise, especially small and medium businesses, through loans, equity, guarantees, and technical assistance. They serve as catalysts, mobilizing additional investment by bringing in other financiers. They are tasked with promoting sustainability, often financing renewable energy, climate projects, and social services. And, importantly, they play a counter-cyclical role, stepping in to provide capital during periods of downturn when private credit dries up. In essence, a DFI is not a commercial bank in the ordinary sense. It is a state-backed or multilateral body, guided by a development purpose, subject to rules of prudence and accountability, and working to channel finance into projects that have long-term benefit but would otherwise struggle to find funding in private markets. Who in Pakistan decides the status of an institution is to be a development finance institution? In Pakistan, the status of a development finance institution, DFI, is determined through a collaborative process led by two key institutions, the State Bank of Pakistan, SBP, and the Ministry of Finance. The SBP, as the country's central bank and primary financial regulator, plays a central role in licensing and regulating DFIs. It sets the regulatory and supervisory framework under laws such as the Banking Companies Ordinance, 1962, and defines the operational scope, capital requirements, and governance standards for these institutions. Commercial banks and other financial institutions are established under Banking Companies Ordinance. Some of these financial institutions are regulated by the SBP, and some other are by the SECP. DFIs are regulated under the Development Financial Institutions, DFI, Act, 2023. The SBP evaluates whether a financial entity qualifies as a DFI based on its developmental mandate, funding structure, and long-term financing objectives, particularly in sectors like infrastructure, housing, and small and medium enterprises, SMEs. At the same time, the Ministry of Finance, representing the federal government, shapes the strategic direction and policy rationale behind the establishment or transformation of DFIs. The government often initiates the creation of such institutions to fulfill national development goals, mobilize long-term savings, and support priority economic sectors. In some cases, DFIs are established through specific legislative acts or presidential ordinances, underscoring the role of public policy in defining their status and mission. A recent example is the government's initiative in 2023 to 2024 to establish a new Pakistan Development Finance Institution, PDFI, aimed at boosting infrastructure investment with support from international financial institutions like the World Bank and IMF. The design, mandate, and regulatory status of this proposed institution are being jointly developed by the Ministry of Finance and the State Bank of Pakistan. In essence, while the SBP provides the regulatory legitimacy and oversight, the Ministry of Finance drives the policy and institutional framework. Together, they determine the legal, functional, and operational status of development finance institutions, ensuring they align with both financial stability objectives and broader economic development goals. If commercial banks are the circulatory system of Pakistan's economy, fast-moving, short-term and reactive, the DFIs are its skeletal and muscular framework, slower to deploy, but structurally indispensable for building factories, power plants, housing colonies, and agro-processing hubs. Their continued relevance hinges on capital replenishment, professional governance, and strict adherence to development mandates rather than short-term profit maximization. These institutions were created through partnerships either with foreign governments and investors, or to focus on specific sectors. There are 10 main development institutions in Pakistan. The government owns most of the shares in these institutions, but they also get money and support from foreign governments and financial partners. Pak Kuwait Investment Company leads the list, followed in quick succession by Pak Oman Investment Company and the Saudi Pak Industrial and Agricultural Investment Company. Their names alone evoke the long-standing economic friendships that underpin them. The same spirit of collaboration is visible in Pak Libya Holding Company, Pak Brunei Investment Company, and the Pak China Investment Company, each a living bridge between Pakistan and its partners across the Arabian Sea and the Himalayas. Closer to home, House Building Finance Corporation channels its energies into housing, while Pak Iran Investment Company Limited focus on industrial growth. Alongside these 10, Pakistan's financial architecture also shelters 3 sector-specific or legacy DFIs whose mandates were once sharply etched for particular development objectives and whose mixed shareholding still carries the imprint of their original purpose. Zari Tariq Tayatai Bank Limited, formerly the Agricultural Development Bank, continues to anchor the rural economy with credit and know-how. SME Bank, though fragile and living on borrowed time, remains technically on the roster, a reminder of past ambitions to nurture small and medium enterprises. And the Punjab Provincial Development Bank, now relicensed as a commercial bank, has not fully shed its DFI heritage, within its new commercial skin still beat the developmental functions that once defined it. Development finance institutions, DFIs, in Pakistan were to play a crucial role in promoting industrial and economic growth by providing long-term financing, particularly to sectors that may not attract conventional commercial banks. These institutions were to support infrastructure development, small and medium enterprises, SMEs, and strategic industries through tailored financial products and government-backed initiatives. Despite facing challenges such as financial sustainability and governance issues, DFIs are instrumental in bridging investment gaps and fostering inclusive economic development in the country.